so this section's 11.1, saving and investing. It's pages 277 to 283 in your book. If you have a hard time following, because I know my voice is kind of deep and kind of hard to understand sometimes, you can look through the book, and a lot of this is right off the book. Also, Plumber needs to be handing out your review packets. So because like the answers and stuff will be scattered throughout the presentation if you pay attention. Alright. So what are investments? An investment is the act of redirecting resources from being consumed today so that they may create benefits for the future. So these are like stocks. These are stocks, your education, which you should be focusing on, not slacking off, and just like storing money in your bank in like a savings account. This is essential to a free market economy because it grows and contributes to its wealth. Now, you may be wondering, well, how is a stock an investment? Well, stock, what you do is you just like it says, you redirect your resources, so you redirect your money into a stock so that it can generate more money or benefits for the future. Same thing for your education. However, it's not money. You're investing your time so that you can get the benefit of graduating, be able to actually join the normal workforce, not go to McDonald's, like be able to go to college. And then a bank example. So let's say Jim here. Jim here is gonna put his money in his savings account because he got off work or something. So he puts it in the bank, and then the bank, Jim still has the money, owns the money, but the bank is able to use it. So the bank will use it for, let's say this is Bob, and he wants to get a business loan. So the bank is going to take some of Jim's money and give it to Bob in a business loan, and then Bob will create jobs with his business, and that'll boost the economy because more people are getting jobs and making money. Don't get confused. Jim can still get his money anytime he wants. The bank still owes him the money he deposited. So, yeah. So, what is a financial system? Yeah, financial system is the network of structures and mechanisms that allows the transfer of money between savers and borrowers. So that's pretty much the definition of like the banks, pretty much. Banks are pretty much a system, and the banks and financial intermediaries, which we'll talk about later, are pretty much a system that allows savers and borrowers to transfer money between each other. This is accomplished through the sharing of financial assets. And financial assets are like your money, your stocks, like your house, that kind of thing. The definition for it is a claim on the property or income of a borrower. The trading of financial assets happens through financial intermediaries. Financial intermediaries are institutions that help channel funds from savers to borrowers. I'd be like banks, like I just said, banks, saving and loans associations, credit unions, finance companies, mutual funds. If you have any questions on these, if you want to know more about it, just ask Plumber. You can pause the video too if he wants to explain each of them, and he can maybe explain his own investments, what he's invested in, that kind of thing. Mutual fund is an organization that pools the savings of many individuals and invests this money in a variety of stocks, bonds, and other financial assets. Hedge funds. A hedge fund is a private investment organization that employs risky strategies that often make huge profits for investors. Life insurance, and then there's life insurance companies. Again, you invest money in there so that the life insurance company can pay for some of your bills later on down the road. If you want to know more about it, ask a plumber and ask your parents too. And pension funds. So a pension fund, you won't have to know this for a quiz or anything, but a pension fund is basically a like when you work at a business for a long time, like it's basically money you get after working at a business for so long and you've reached a certain age that like you retired, you like pension money because you worked at there so long, you're so loyal. So what are the risks of investments? There's four main ones. There's credit risk, liquidity risk, inflation risk, and time risk. Credit risk is borrowers that may not pay back the money they have borrowed or may be late making payments. What the book says is you lend $20 to your cousin who promises to pay you back in 2 weeks. When your cousin fails to pay you on time, you don't have money for the basketball tickets that were planning to buy. So that, again, that's not like a really huge consequence, but what they're saying is, basically what they're saying is the people who you lend money to, the borrowers, they may be late in making payments, so you can't do anything like you really need to do. There's liquidity risk. You may not be able to convert the investment back into cash quickly enough for your needs. We'll talk about liquidity later on. The book says your MP3 player is worth $100. You need cash to buy concert tickets, so you decide to sell your MP3 player. To convert your MP3 into cash on such a short notice, you have to discount the price to $75. So since you convert it so quickly and people might not want it at the time or whatever, you might have to discount the price to get them, to convert it back into money. It's also inflation risk. Inflation rates erode the value of your assets. Ricardo lends Jeff $1,000 for 1 year at 10% interest. If the inflation rate is 12%, Ricardo loses money. And that's because with inflation, that means a lot of money. There's just a lot of money like in the economy and the system, so money is worth less since it's less scarce. So that means some of Ricardo's money is Ricardo's money is worth less now than it was because it's less scarce. Again, if you have questions about inflation, you can ask a plumber, but he would explain it probably better than I do. Time risk. You may have to pass up better opportunities for investment. Lily invests $100 in May's cleaning business to be repaid 5% interest 1 year later. 6 months later, Lily is unable to invest in Sonia's pet sitting business, which pays 10% interest because she has already invested in her savings. That's also kind of opportunity cost. Pretty much what they're saying is that you may have to pass up bigger and better things because you already sunk time and you've already invested in smaller things. So yeah, just kind of be careful, do a lot of research, and don't be like, look. Yeah, if you have questions on these, I bet Plumber can answer them for you. If I went through every single one of these, it would if I sat there and explained in depth every single one of these, that would just take so long. How can I mitigate these risks? You can mitigate those risks by using diversification. Diversification is a strategy of spreading out investments to reduce risks. This can be achieved through financial intermediaries, like what we talked about, banks, saving and loan associations, that kind of thing. Why is this important? Well, why is this important? Why should I care? Why should I use diversification? Well, have you heard the saying, don't put all your eggs in one basket? Well, that's pretty good. That's pretty good advice because if you, let's say with the example, you have 4 boards. You invest all your money in 4 boards. Well, if it were to crumble or go down a little bit, I'm not saying it will, but if it were, you'll lose all that money. So you just lost your eggs in a basket essentially. But instead, you spread out your eggs or your money. Maybe you put $100 in floorboards. Put $100 in your savings account, so you spread out your eggs. You put $100 in Petco, and then you invest in your boy Elon and put $300 because he's a baller. So that's probably a better spread of your money, except for don't put $300 in Elon. That's just an example. That's a better spread of your money because if, say, floorboards were to go get down, again, I'm not saying it will, sorry plumber, then you still have your money spread everywhere else and you don't lose all of it. Where can I get more information on investments? Financial intermediaries can do more to help you with diversification. They can also provide information on investments. They do this through keeping track of stocks in the portfolios. And if you don't know what a portfolio is, it's a collection of financial assets. As a vocab word, you will need to know it. They are required by law to provide this information in a prospectus. Prospectus is an investment report that provides information to potential investors. So no matter what, they have to give you this because it's required by law. And this is an example of a portfolio. As you can see, they're tracking many stocks like Apple, Google, Hewlett-Packard. They're tracking their price changes, how they're going on the market, that kind of thing. This is an example of a prospectus, and they're comparing portfolios, saying which company has been doing better than the other, and so that can give you better advice on like what to invest in. How can I move around my assets and investments? So say if you're like kind of in a bad deal, you need your money. This can be achieved through liquidity. Liquidity is the ability to convert an asset into cash. So in the book, this one student bought like a pair of shoes or something like that, and actually, wait, hold on, pause the video. Sorry. So in the book, they talk about how you invest in a mutual fund, but later on down the road, you're about to go to college. You need to go pay for college. So you can get the cash quickly by selling your shares in the mutual fund. So that's because it's very liquid. It's a mutual fund. But other investments are not so liquid. Say if you purchase an investment quality painting instead. So instead you buy like a fancy painting. That doesn't really provide crucial meeting borrowers and lenders' needs of the increasing complex financial system. So that may not be so liquid because some people may not want the painting. Some people may not like the painting. You convert assets back to money, you'll get returns as well. Pretty much returns are money that investor receives above and beyond what the sum of money initially invested. So pretty much it's like extra money. It's like more of the profits. Alright, so what do you need to know for the quiz? What do you need to know out of all this? First of all, what's an investment? What's a financial system? What are financial assets? What are financial intermediaries? What's a mutual fund? What is a hedge fund? What is credit risk? What is a liquidity risk? What is inflation risk? What is time risk? What is diversification? What is portfolio? What is a prospectus? What is liquidity? And what are returns? Pretty much all the vocab. Now I might have some bonus questions, so be on the lookout for that. I'm probably not going to be as generous as I was last time. So yeah, it's just pretty much everything in the bold. Okay. Then if you are watching this in December, Merry Christmas.